Welcome back to this episode. We're going to look now at some analytics that can help classify trends in financial data. This is a huge topic and we're not going to look at everything that's possible, but we'll just give you an idea of how visualization can help to some extent to understand more about data in time series. So this is the data we've looked at so far. These are the four companies, ULE, Spirent, SPT, Unilever and Orgum, AUGM. They're different types of companies and they have different trends in their stock prices. And in general, one of the things we're looking at in stock trading is when to buy and when to sell. It's not really possible to tell you that, and one of the reasons for that is because it's thought that stock prices are really random variables. That means there's no prediction power in previous data for the future, certainly in the short term and the long term. There's various studies on this. Howry in 1965 looked at whether the stock price is random or predictable and concluded they were random. And there's Investopedia have a nice page on the random walk theory. So the random walk theory really says that stock prices wander around up and down all over the place, but there's no particular trend you could spot from a week or a month or a year of data. However, everyone who trades is always hopeful. And they're also looking at what kind of things are happening in a particular share price. So with ULE, for example, if we could have predicted that huge price increase when the takeover bid was made, we'd have probably made a profit. More generally, people who do make profits in the stock market tend to rely on an understanding of the trends, the sentiment in the market, what people think about the future, and some of the more obvious things. So one of my colleagues made a huge bet on COVID. Before COVID drop in the stock market, they sold most of their assets. At the lowest point in the market, shortly after the drop, they invested it all again and they doubled their overall capital just by that trade. So let's look at one of the most basic tools for smoothing out some of the noise in the stock market, and that's rolling averages or moving averages. So in this plot here, there's two lines. The solid line is the smoothed rolling average, and the dotted line is the underlying raw share price data we downloaded from Y-Finance. Smoothing out just over a short time period like 7 days helps see trends, helps, as you can see around about here, for example, helps smooth out short-term fluctuations so that you're not distracted by those and you can see overall whether prices are rising or falling. It's certainly the case in the COVID data that smoothing the data helps understand if the trend's up or down. And the trends in the COVID data you tend to see over weeks or months. Watching the daily fluctuations is not always so helpful. So in Python, there is a simple way to produce these rolling or moving averages. You can pass in a data frame column. So here we're sending in the closing price from the symbol data. You then use the function rolling and give it a window in number of units, in this case days, of which to average, or any other calculation you want, in fact. It will then automatically select out every 7-day window across the whole data set, and in this case pass it through to the function mean, which will calculate the average for those 7 days, and store it back into a list, and that list will contain all of the 7-day averages for every point on the price data that you've sent to it. Let's notice an important thing here. At the beginning of time, there is no solid line because you can't calculate the first rolling average until at least 7 days into the data. So that rolling average for the first 6 days will be not a number until on the 7th day we can calculate the first 7-day rolling average. So whatever time period you choose, you have to have data up to that time period before you can calculate it. This is a one-way rolling average, so it's only going back in time from the current point. You can get windows which span both forward and backward time, and you get gaps at the beginning and the end of the data sets for those too. Just to recap, we're taking the symbol data, the closing share price, we're extracting every 7-day window from that data set, and we're calculating the mean for those 7 days and putting that back into a list to allow us to plot the solid blue line, which we're doing with that plot call just beneath in the code. So then the question is, what about volatility? Share prices bounce around a lot, and if they're being very volatile, there might be opportunities for trading. If they're being very unvolatile, there might be less opportunities. How do you measure volatility? Well, in statistics, the very standard ways to use variance and standard deviation. And in finances, in fact, they tend to use, one of the metrics they use is also standard deviation. but a guy called John Bollinger invented the idea of Bollinger Bands, which are very common in statistics but are named in finance Bollinger Bands. And this tells you for any point in time what the variance was over the 7 days, in this case, as we're smoothing averages over 7 days, prior to that. So his recommendation is that you plot the smooth average, the solid blue line again, and then above that and below that, the upper and lower Bollinger Bands. And they're defined by the variance value for the smoothed average over the 7 days at the point that it was calculated. And they're defined by a value that is normally, not always, but normally twice the standard deviation value. In times of very smooth variation, so the price isn't changing very much, you'll get very close, very tight fitting Bollinger Bands. Over here you'll see that the Bollinger Bands shoot out either side once we've got that large change in the ULE share price when the takeover bid was announced. One of the ways that you might want to interpret this, and one of the ways that it's recommended to interpret this, is that at points where the share price approaches the upper limits of the Bollinger Bands, that's where the shares may be being overbought, so the price is excessive compared to what its trend might be. And on the other way around, if the price approaches the bottom Bollinger Band, they might be oversold, and that might mean that it's a good time to buy because the price is low compared to recent prices. Some people do extract trading strategies around this, but remember that these are statistical strategies around things which are random variables, and it uses statistical methodologies in ways in which are not quite accurate statistically. So there's not usually a normal distribution in share data. So, interpreting these Bollinger Bands, this is from Investopedia. They are very popular and they're not without use in showing whether the share price is staying within a defined range of volatility, which is around about 95% of all volatility will be in this range. So many people believe that if you get close to this upper band, they're overbought, and they're closer to the lower band, they're oversold. So if they're overbought, it means the market's pushing the price up and up and up and up beyond what you might think is reasonable. If they're oversold, it means that they're dropping in prices and it might be a good time to buy. It also might mean the bottom is falling out of the market and you'll lose all your money. So I'll go back to Jupyter Code and we'll just check that it still runs. And indeed it does. We'll import the libraries we need. And we're only going to use standard matplotlib libraries here. This code reads in the data, so we're bringing in the same data we downloaded from YFinance before. This code reads in the data. This is bringing in the same data we used before from YFinance for the 4 companies, ULE, SBT, ULVR, and AUGM. And we've extracted a symbol list of all 4 companies. We'll do the same 2x2 4 plot small multiples. But this time we're going to use the slightly different code to add to the smooth moving averages, the Bollinger Bands. Okay, so this code should run through and plot the 4 plots for us with the smoothing averages on them. There we go. So this is a 7-day smooth average, the rolling average for ULE, SBT, AUGM, and Unilever ULVR. So now we've got the smooth average plotted. We've added in the code to calculate the Bollinger Bands. So from that, we need, in exactly the same way we calculated the rolling mean, we need the rolling standard deviation. So instead of calling mean for each weekly 7-day period, we calculate STD, which calculates the variance and then the standard deviation for each 7-day period. And that gives us a list, as SMA gives us a list. Once we've got that, we can then calculate the upper Bollinger limit as the smooth moving average plus 2 times the standard deviation value, and the lower Bollinger Band as the smooth moving average minus 2 times the standard deviation. And then plot those, the upper one in green and the lower one in red, as dashed lines with this line style dashed. So let's run that and check that that works. Okay, so now we've got closing prices, the 7-day rolling average, and the Bollinger Bands on the year to date for 2021. And you'll see, as we saw in the slides, that this almost hits the upper band there as the share price suddenly takes off when ULE's takeover bid was announced. Okay, so that's Bollinger Bands and the code in Python for creating them. I'll just finish with a warning that trading is risky and you're liable to lose money in it as likely as you are to make money in it. In fact, probably more likely to lose money. It's increasingly difficult for retail investors to make money in the stock market. The big banks tend to have extracted value from it already, and beneath that they trade in sub-second speeds by detecting tiny micro movements in the market. So they tend to have extracted value in changes from the market before your 15-minute delayed data even arrives on your PC. So thank you for watching. I'll see you again soon in another episode.